Welcome to the Deep Dive. Today, we're getting into financial risk management.
Yeah, it's a big topic. We've got sources covering definitions, risk types, returns, mitigation, even currency risk.
Exactly. And our mission is really to pull out the key insights,
Mhm.
to help you understand and navigate these financial uncertainties without getting totally bogged down in detail.
Let's jump in. The absolute core idea is that risk and return are linked.
Okay? So define risk for us again.
Simply put, risk is the chance of a financial loss, or maybe just uncertainty about the returns you'll get.
And return is just the gain or loss you actually make on an investment.
Precisely. The total gain or loss, and well, the general rule of thumb is greater risk often comes with the potential for greater return.
Potential being the key word there. And
Absolutely.
people react to this differently, right? You've got different preferences.
Yeah, basically three types. Risk indifferent, who don't really care about risk. Risk averse, that's most people, wanting more return for taking more risk. And then risk seeking, the ones who might actually enjoy the gamble.
Interesting. Okay, so how do we break down the types of risk? I saw this DUNS acronym mentioned.
Right, DUNS.
Yes.
DU is for diversifiable risk, also called unsystematic or firm specific. Think random events hitting one company or industry, like a strike or a lawsuit.
Stuff you can potentially lessen by not putting all your eggs in one basket.
Exactly, through diversification. Though, even that has limits in a big crisis.
Okay, so N in DUNS.
Non-diversifiable. Or systematic market risk. This is the big picture stuff. War, inflation, recession fears. It affects almost everyone.
And you can't diversify that away.
Nope, it's inherent in the market. Then you've got others. Interest rate risk, how rate changes hit investment value. Credit risk, can the borrower get funds? Default risk, will they pay you back? Liquidity, can you sell easily? And price risk, just the risk your asset value drops.
Wow, okay, lots of angles.
Mm.
Now, talking returns, it's not just one number, is it? Stated versus effective rates.
That's a crucial point. The stated rate is just the advertised number, but the effective rate includes fees, showing the actual cost.
So like on a loan, the effective rate might be higher than the stated 10% because of processing fees.
Exactly. Then there's APR, annual percentage rate. That's like the effective rate, but not compounded within the year. And ER, effective annual percentage rate, does include compounding.
So ER is the truest picture of the annual cost.
Generally, yes, especially when comparing different options. And don't forget simple versus compound interest. Compound interest earns interest on interest, making a big difference over time.
Right, and investors have a required rate of return.
Yes, what they need to earn to make an investment worthwhile. It's basically the risk-free rate plus additions or premiums for different risks. Maturity, inflation, liquidity, default.
The riskier it is, the higher those premiums and the higher the required return.
You got it.
Okay, so strategies. How do you actually manage all this risk?
Well, diversification, as we said, tackles that firm-specific risk for interest rates, maybe floating rate debt or swaps, market risk. Some use derivatives or short selling.
Short selling, betting against the market, essentially.
In a way, yes. For credit risk, improving your own rating helps. For default risk, lenders can be selective or adjust interest rates. Liquidity risk means favoring active markets. And price risk. Again, diversification, maybe short selling or put options.
It's like a financial toolkit. Now, currency exchange risk. That sounds complicated.
It can be, yeah. It exists simply because the value of one currency fluctuates against another. If you do business internationally, it's a factor.
And what drives those fluctuations?
Things like relative inflation rates, income levels, changing demand, government actions, different interest rates between countries, capital flows. Lots of moving parts.
So if U.S. inflation is higher than, say, Mexico's, the dollar might weaken against the peso.
Generally, yes, that's the idea. Now, this risk shows up in a few ways. Transaction exposure is the risk on individual deals due to rate changes between ordering and paying.
Like that U.S. company buying from Europe we mentioned earlier.
Exactly. Then there's economic exposure, the broader impact on your company's overall value and cash flows because of long-term currency trends. A strong home currency might hurt your exports, for example.
Okay, a bigger picture impact.
And finally, translation exposure. This is about how your financial statements look when you consolidate results from foreign subsidiaries back into your home currency.
Right, the accounting side of things.
Yeah.
So how do companies deal with the transaction risk specifically?
Lots of tools here. Hedging, basically. Futures hedges are standardized contracts, good for smaller amounts. Forward hedges are customized, usually with a bank, for larger sums.
Buying or selling currency for a future date at a fixed price.
Pretty much. You can also do a money market hedge, using borrowing and lending in different currencies. Currency options give you the right, not the obligation, to buy or sell at a set price.
Options sound flexible.
They are. For longer terms, you might use long-term forwards or currency swaps, or even simpler things like adjusting payment timing, leading and lagging, or just holding different currencies.
Okay. And that bigger economic exposure, is that just harder to hedge?
It often requires more fundamental changes, yeah. Less about financial instruments and more about restructuring operations, maybe shifting production or sales focus geographically to align better with currency movements. It's definitely more strategic.
Got it. So wrapping up, the big takeaways seem to be risk and return are intertwined. There are many specific types of risk, and there's a whole range of tools and strategies, especially for navigating those tricky currency fluctuations.
That sums it up well, and it really makes you think, doesn't it? In this globalized economy, how a seemingly local event, maybe a policy change or a natural disaster somewhere, could ripple outwards and impact all sorts of financial risks for businesses and even individuals everywhere.
A sobering thought.
Yeah.
Definitely something to keep in mind.